Hello everyone. Welcome to Commodity Monthly Podcast. This is Saif Mukadam, research analyst for Commodity and Currency. Let's discuss on commodity outlook for the month of June 2023. We'll cover all major commodities including bullion, base metal and energy complex. Now let's see what happened in bullion. At the start of the month, spot gold prices made a lifetime high in weakness in dollar. The dollar slipped after US Federal Reserve signaled it would be done raising interest rates for a while. Also, demand for safe haven increased amid ongoing concerns over debt ceiling and deepening worries about the health of regional banks. However, in the second half of the month, gold prices started correcting from their record highs and rebounds in dollar and US Treasury yields. Also, better than expected economic data from the US and hawkish comments from Fed officials fueled bets that interest rates may remain elevated for longer than expected. We expect gold prices for the June to take support near 1900 and rise further till 2000 levels, aim expectation of correction in the dollar and US Treasury yields across the curve. Forecast for upcoming economic data from the US seems to signal that economy is feeling the heat of rate hikes and should support our view of a pause in rate hike from the upcoming meeting and possible rate cut by the end of the year. On top of it, tightening credit conditions due to stress in the banking sector may also prevent the Fed from raising rates. Additionally, investors fear that the debt deal will intensify the risk of recession by limiting government spending, which could make the Fed less likely to keep tightening. Moreover, after the debt deal, the US Treasury has to refill its empty reserve by issuing bonds, probably at a high current interest rates, sucking liquidity from the market. M6 gold prices may move north towards 61,200 as long as it stays above major support level of 58,800 levels. Now let's talk about the base metal. In base metal, we'll cover copper and aluminium. Copper prices slipped for a second consecutive month amid strong dollar and rising stockpiles at LME warehouses. Increase in stockpiles reinforce the picture of weakening demand. Copper stocks in LME warehouses have almost doubled since mid-April. Additionally, weaker than expected growth in industrial output and retail sales numbers from China have raised questions on demand prospect of the metal. Moreover, jitters around the US debt ceiling negotiation also mutated investors' risk sentiment. From a supply perspective, Peru's March copper production jumped 20.4% from a year earlier to reach 219,275 tons as large mines resumed their operations, also weighed on copper prices. We expect M6 copper to face hurdle near 735 levels and slip back to 690 level as China's economic recovery weakened in May, raising fresh fears about the growth outlook. Recent weak economic data from China suggests the post COVID rebound is losing momentum. Further, copper prices may come under pressure, amid persistent rise in copper inventories at LME registered warehouses. Moreover, a contraction in global manufacturing activities across US and Europe could hurt the demand outlook for base metal. However, major declines may not be seen as some cushion is expected in anticipation of correction in dollar and improved risk sentiment encouraged by averting US debt prices. Aluminium prices dropped last month in strong dollar and concerns over global economic growth. Further rise in stock at LME registered warehouses added downside pressure to prices. As per National Bureau of Statistics, China's primary aluminium production rose 0.8% to 3.33 million tons in April compared to the same month a year earlier. For the first 4 months of the year, China produced 13.3 million tons of 3.9% from the corresponding period in 2022. We expect aluminum prices to remain under pressure in concerns over sluggish global economic growth. Additionally, the demand outlook for the metal looks gloomy as weaker economic data from China suggests a post COVID rebound in losing momentum. Additionally, investors fear that issuance of new treasury bills by the US to refill its empty reserves, probably at higher interest rates, may impact bank deposits as people will move to a higher paying and secured government debt. It may put pressure on the liquidity, pushing rates on loan higher for borrowers for the impacting economic growth. M6 aluminium is likely to face hurdle near 212 levels and slip further till 203 levels. Now let's see what happened in crude oil. Crude oil prices tumbled last month and touched $63.64 last seen in December 2021. AIM bounce in dollar. Also, slower economic growth across major countries have dented demand outlook. Further, oil prices dropped on signs of weak manufacturing growth in top crude oil importer China, which raised concerns over weak energy demand from the country. However, some cushion was observed after the International Energy Agency predicted demand would outpace supply by 2 million barrels per day in the second half of the year, with China making up 60% of oil demand growth in 2023. We expect WTI crude oil prices to slip further till $64 this month on concerns over future demand from major countries across the globe. Market participants fear that high interest rates across major countries would hurt economic growth and dent fuel demand. Additionally, mounting concerns about a demand recovery in China will hurt prices. A drop in factory activity and slowdown in the services and contractions and construction sector of China highlighted the lackluster nature of the ongoing recovery in the country. Moreover, investors will remain vigilant ahead of OPEC Plus meeting in Vienna on June 4th, where the cartel will decide on their output policy. We do not see OPEC Plus announcing another cut in production as they will wait to see the impact of earlier cuts. M6 crude oil prices are likely to slip further till 5,300 level as long as it stays below 6,100 levels. M6 natural gas is expected to slip further till 165 level as long as it sustains below 214 level. Thank you. Have a nice day.